Well, welcome to Target Professional Consults. Today, we are going to look at one of the financial reporting standard, very short one, called IAS 40. So IAS 40. It's called investment property. Investment property. Investment property. Or investment properties. Oh, investment properties. Okay, good. Now, like we said, all the standard, when we pick them, you should know the 5 items, 2, 3, 4, 5. You should know first the objective and the scope of that standard. So some definitions stated. You should know the recognition. You should know the measurements. And then you should know the disclosure requirement. Good. These are the 5 items, but I'll go straight to this, that, and this. We are done. These 3, because these are the examinable ones. For the objective and scope, you should know it, and then the disclosure requirement. All of them, they are in the notes or the handouts. You can just familiar yourself with it and then fine. Now let's go straight. But objective of every standard is to prescribe the correct accounting treatment of that, the name of that standard. So IAS 40 talks about investment properties. So investment property. So it means that the objective is to prescribe the correct accounting treatment of what? Investment property or investment properties. Good. The scope, the coverage. We look at that. Now let's start with the definition for investment property. So that's the basic definition. This standard, it opposes the IAS 16. That's the property, plant, and equipment. So most of the items that we saw under the property, plant, equipment also be in here. So I'll run through them so that we just look at the added version, then you'll be fine. Good. Now let's see the definition for investment property. Define investment property. In fact, the definition is very long and I have a lot of terms in it. So what I'll do is I'll break it down to 3 features. In fact, 3 features that form the definition of what investment property. So I'll break it down for you. Good. So now let's look at the definition of investment property. May be called upon to define investment property, then give examples. So let's look at the definition. So investment property, they are properties made up of what? So investment property is a property made up of, so the definition, 1, 3 features coming together. So the property made up of land or building. Land or building. Good. Land or building. Then, or a part of a building. A part of building. So land or building, comma, or parts of what? Of building, or both. Good. Or both part of land and part of what? Building. So that is it. Or both. Good. held by an entity. Held by an entity. So held by an entity. So let's go to the board. So held by entity. Wow. So held by entity down. I know great. Or acquired by an entity. Acquired by an entity with an intention not for resale. So with an intention not for resale in an ordinary course of business, or not for use. Not for use or resale in an ordinary course of business. So not for resale or for use in an ordinary course of what? Business. If you acquired a property which is made up of land or a building or parts or both, that the idea is you're not going to what? Use it nor sell it, then it's what? Investment property. Good. So not for use in production of goods and services, or for administrative purposes. So the use is administrative purposes, or sale, so not for use in production or admin purposes, or sale, not for sale in an ordinary course of what? Business. Not for sale in an ordinary course of business. Not for sale in an ordinary course of what? Business. Now, let's see. Why will you acquire a property which is made up of land or building? Then you say, one, you're not going to use it in your production, or you're not going to use it to run your administrative service, or you're not going to sell it in an ordinary course of business. Ordinary cost of business, no. But what for? So the reason is here. But for rental income or capital appreciation or both. So but for rental income or capital appreciation or both. Yes, you need all the two. So you acquire that property mainly not for resale or not for use in your production of goods and services or for rental. Now the issue is this: you acquire that property mainly for rental or for capital appreciation, rental income or capital appreciation. Now the capital appreciation will be like this: you're waiting for the value of that land to appreciate and sell it at higher amount. So initially, you did not acquire the land for sale. You're going to sell it at later days. So future dates, you will sell the land. But for now, we are not selling it. That is investment property. Or for both, you rent, you let people be renting it for a rental income or a charge. At the same time, when the value appreciates, you dispose it of. So that's the definition. So combining all these three key features together, they form a definition of investment property. Because of this, it's been topical issue. So kindly get for it. Good. Great. So now let's look at some few examples of investment property. Few examples of investment property. So examples of investment property. Few examples of investment properties. Few examples of investment property. Now, land held for long-term capital appreciation. So examples include example one, land. Yes, qualified. Land held for long-term capital appreciation is needed. So that is what investment property. Land held for long-term capital appreciation. So appreciation must become there. Good. Now two, the second example of the investment property will be a building lease out under operating lease. So building lease out under what? Operating lease. So that means you have a building you own by an entity, good. Then you lease it out. So building owned by an entity, leased out, and operating lease. Good. So if you have a building and you lease it out under operating lease, it qualifies to be what? Investment property. Good. So that is it. Basically, that is the line, right? Now let's see. Now what about parent? Parent and subsidiary. The example 3 is a very crucial and topical issue. Assuming that in a group account consolidation, the parents have leased out some equipment to the subsidiaries. So company A is the parent. So parent company have leased out a piece of equipment to that of the subsidiary. How do you treat it? Yes. In the individual accounts, in the parent book, the one that giving the asset out, it's qualified to be what? Investment property. So property owned by who? The parent, leased out to the subsidiary. In a parent book, in the parent books, it's what? IT, investment property. What about in a group account? In a group account, no. There's no investment property. In a group account, we call it must be PP. So that is the difference. So in a parent book, it's qualified to be investment property because the parent is renting a piece of equipment. In fact, it must be a building or land. So the parent is what? Renting some of it empty facilities or empty buildings, or renting some of it vacant rooms to that of the subsidiary. In a parent book, it's investment property, but on the group account, we classify as what? Investment property, plant and equipment, or owner occupied property. Owner occupied. So all the PP, we also call it owner occupied property. The owner has what? Occupied in. So that's good. So that's example 3. So the example 3 will be a building held by a parent and leased to a subsidiary. Good. So a building held by parents and leased to what? A subsidiary. Building held by parents and leased out to a subsidiary. So in the parent book, it's an investment property. In the subsidiary book, is what? In a subsidiary book, what will be? So how would the parent account for? And then what about the group, almighty group account? Good. So in the parent book, it's investment property, and then in a subsidiary book, it becomes PPE, and then in a group account, it's also PPE. Yes. So that is it. And the last one is any asset that you've constructed or you've acquired. Not any asset though. It must be land and building. So any land or building that you've acquired and you've developed currently for undetermined use. Maybe you finish building office, the office building. Such you finish, but you don't know whether you are going to occupy in or you're going to even lease it out. So asset now, but it qualifies to be what investment property. So that is it. Now, if you look at the examples, now the following are not investment properties. The following buildings that are for sale in an ordinary course of activity, like the estate developers, the land and building that are ready for sale, they are not what? They are not investment property. Instead, they are what? Inventory. That's the trading stocks. That's their inventory. Good. Except for if there are some of the land that are intentionally arranged for future sale or future use. That is investment property. For now, good. Or property being constructed or developed on behalf of a third party. That one must be accounted for in the IFRS 15. So that one is not an investment property. If you are building, so you are a contractor, yes, if you are a constructor and then you are constructing a building for someone. In fact, that building is not, you cannot classify it in your book as what? Owner occupied. No, the IAS 40, that's investment property. So you should take note. And then owner occupied property, that's IAS 16. All these are not what? Are not investment properties. So we are done. Now let's go to the recognition of investment property. It's the same as the recognition of what? PP. So we will just move on. So refer to the recognition of PPE. PPEs are what? They are non-current assets, so tangible non-current assets. If two conditions are there, so you do the same thing. So you only record investment property as non-current asset if two conditions are there. One, it's probable that future economic benefits embedded in the investment property will flow to the entity, and the cost of the investment property can be measured with reliably. These two conditions. So we are done with what? The recognition of investment property. Then we go to measurement. Measurement to, as usual, we have what? Initial measurement. Now let's look at the initial measurement. How do you record PP initially? How do you record PP initially? It must be recorded at cost. What about investment property? So initially, investment property must also be recorded at what? At cost or measured at cost. So it must be valued at cost. 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 Good. Now the cost that we saw under the IAS 16 PPE, it's also valid here. It includes all costs that are directly attributable to the asset or to bring the asset to its present condition or to make the asset ready for its intended use, that's the rental or sale in future periods. Good. So that's the initial measurement. So here, all costs in the IAS 16, just that because it's land and building, some of the costs might not be valid here. For instance, transportation cost, don't mention it in, because you cannot transport what land or building. So instead, it will be what construction cost, site preparation, then the other stuff. Good. Then let's go to the subsequent measurements, and that's the end of the game. Subsequent measurement of investment property. Subsequent measurement of investment property. So subsequently, investment property must be measured. Subsequently, investment property must be measured using any of these two. So here too, the choice here, we have what you call the cost model. Wow. And fair value model. Fair value model. There's the good news. The good news is that the cost model that we saw under the IAS 16 is the same. So it's the same as what? IAS 16 cost model. Wow, so we are done with it. Whatever we stated there is also valid. So that means you can have investment property, which will be on depreciation. So here, if you want to get a current amount, bring the cost of the investment property, less any accumulated depreciation, less any accumulated what? Impairment loss. So that is the cost model. Good. However, fair value model is not the same as the revaluation model and the IAS 16. The difference. So let's consider the difference between these two models. Good. And then we look at some few issues. Then we are done with IAS 40. What level is the question solving? Kindly be with us when we start the question solving stage. Good. Now, what's the difference for the fair value model under the IAS 40? The difference between that one and that of the revaluation model and the IAS 16. Here, you are saying they are not the same. So, yes, there are differences. What's the difference? Now, let's look at the difference. And then we see it's a very topical issue that you have to take note of. So here, right, IAS 40. IAS 40 here. All right, IAS 16 here. Good. So this one is fair value model. So let me repeat. IAS 40, call it fair value model. And then IAS 16, call it what? Revaluation model. That's IAS 16. In fact, I've changed the thing. I've swapped it to. The revaluation model. Good. Good. Now this will be the factor. The first difference is that here we don't depreciate the asset under fair value model according to IAS 40. The first is depreciation. Do you depreciate the asset here? No. There's no depreciation. No depreciation. Any investment property valued under the or held under the fair value model, no depreciation. Don't depreciate that investment property. What about IAS 16? Yes, there's subsequent depreciation. So we do what? Yes, we depreciate the asset. We depreciate the assets. Yes, there was what? Depreciation. That's the first difference. Second, how do you find the carrying amount of the asset? The second is the carrying amount. See, carrying amount of the investment property is equal to the fair value at the end of the reporting period. So the carrying amount of the investment property is equal to what? The fair value at what? At the end of that period. So it's the same as the fair value. So carrying amount is equal to the fair value. What about IAS 16? Carrying amount is not equal to the fair value, but rather it's equal to what? Carrying amount is equal to the fair value less what? Subsequent accumulated depreciation. How we get a difference? Good. And subsequent accumulated what? Impairment loss. Difference number 3. Changes in fair value. What do you report it? Changes in fair value. That's the revaluation gain versus fair value gain. Over here, we call it fair value gain or loss. Changes, all the changes must be reported in the profit and loss. So record it in the profit or loss account. It must be in the P&L. If it's a gain, add it to other income. If it's a loss, operating expenses. But here, gains are reported in where? OCI. And then losses are reported in where? P&L. So have you seen the difference? But here, whether it's a gain or loss, it must go to the P&L. So difference is clear. Number 4. Difference number 4. Here, the valuation must be done periodically, and then every year, annually. So that is it. But let me chip in this. The frequency, the assets for the fair value can only apply to land and building. Land and building, or land or building. But here you can apply to all PPs, all PPs, or the IAS 16 will apply to all non-current assets. In fact, revaluation can be applied to all non-current assets. Let me expand it. Good. Then we are done. The 5th one, but here, if you adopt fair value model, all your investment property, you have to adopt the fair value model. So that's the danger. But under the IAS 16 valuation model, only a class, good, only what? A class must be fair valued. So assume that here you have 10 rooms. So here, if you're going to the revaluation model, all the 10 rooms have to apply the revaluation model. It means that the other buildings or let's say other asset, other class like plants, that one we're not going to apply what? The evaluation model. But under the fair value model, assume that you have 5 pieces of land, different location, then let's say 5 plots of land, and then you have 10 office buildings, 10 buildings. So all these are investment properties, 10 buildings that you are renting somewhere and 5 pieces of land. And the standard is saying that, in fact, if you adopt fair value for the land the building you have to adopt. In fact, you're in the same class, land and building are in the same class. So it box on to that of the revaluation model. So this are the difference between the fair value model and then the revaluation model. Good. Now let's consider the last aspect of the standards. Then we are done with the tuition section or the principal section. What level is what in the practice. Good. Now the last aspect will be transfers. Good. Transfers. So it can be from owner occupied to investment property and vice versa. So transfer number one can be owner occupied to investment property. So it can be like this or it can also be like this. Yes. Example, owner occupied to investment property. Now your head office that you are using currently. Let's assume that you have constructed a new facility for the head office. So that means the current head office will be what? Be idle. Okay. So let us now give it out. Hold it as what? As investment property. So to be held as investment property. So that's from owner occupied to what? Investment property. And then reverse. That's from investment property to owner occupied. Yes. We have some nice apartments at East Legon that are going for rent. Now we can relocate our head office to that building. Now that building becomes what? Owner occupied. From where? Investment property. So basically, this is the transfer between investment property and then the owner occupied. Two, can also transfer between what? Between investment property and inventory. Inventory and vice versa. Investment property versus inventory. You are selling some land. That's your inventory. All to that you sell land. You buy and sell land or building. And this particular land or the building that you are selling, in fact, over 50 years, nobody is buying. Okay, and so okay. Now let me leave this building. Let me give you just 10 years. After 10 years, the value will appreciate and sell it better. So that inventory becomes what? Investment property. And then you can also transfer a property from investment property to what? Inventory. Example, we have some apartment at East Legon that was going for rent. So now you deal in apartments, just that that apartment wasn't for sale, it was just for investment potential. But now it's ready for you to sell. So you move it to inventory and classify as what? Goods that are ready for sale. Then the third transfer will be between cost model to fair value model. So the same investment property, you can transfer. Formerly you're using the cost model, but now if you like want to use what? Fair value model and vice versa. Good. So that's the transfers. All of this have calculation. Good. Especially from owner occupied to investment property. So can you be with us at the question solving stage? We'll pick a question under each stage and then do justice with it. So That is the game. So this is how far the good Lord brings us on investment property. The remaining section is the question solving. Just to complete the lecture, join the question solving or the second video or the lecture of the investment property. Please, if you have not subscribed, kindly subscribe to the page, share, then like the page. But if you do have any question, kindly forward it to our mails and also forward it to our Facebook page, Target Professional Consult. We'll pick it up and then work it for you. Great.